don't know what the problem is, how long will you spend trying to fix it? And if there was a way to identify the single biggest thing holding your wealth back, how valuable would that be? I didn't know what I didn't know. And that's one of the most frustrating things I realized when I first learned about the money problem and infinite banking. I grew up like most people in a world where there was only one way of doing things. You worked, you put your money in the bank, and that was it. Keeping money at home, that was for criminals. And dangerous, because you could get robbed, you know. That's the general knowledge we've all been handed down about money. Thinking that I could put money in my own banking system that I controlled was unimaginable. And honestly, even if I did try to imagine it, it kind of felt wrong. Like I was thinking like a criminal. But later, I found out in 1960, over 40% of adults in America use life insurance as their primary savings vehicle. And I'm not going to go down the conspiracy theorist rabbit hole here, but it is interesting how quickly people forgot all about that once the banks were allowed to loan out 10 times more money than they had on deposit, right after going off the gold reserve. My name's Andrew Majoris, founder of WealthGuard Life Solutions. And in this video, we're going to talk about the money problem and the two thieves that are stealing control of our money. Then we're going to talk about a solution using the infinite banking concept. Then I'm going to show you exactly how to take back control of our money and shield it from the greedy fingers of taxes and interest payments. Let's get into it. So the first thief is taxes. This is a CTV news article, and taxes are the largest household expenses in Canada. And they published a study by the Fraser Institute, and they found that 43% of income is getting spent on taxes alone in 2023. And here's a quote: "It was surprising to me that the results of the study, because so many of those taxes were hidden," says financial planner and CEO Black Star Wealth. "You don't even realize they're adding up." So it's not just income tax we need to worry about. There's property tax, there's GST, PST, HST, depending on where you live. There's carbon tax, there's tax, you know, municipal tax. It's everywhere, and they start adding up quite a bit. So if we go to I'll post all the links in the video comments here, but if we go to the Fraser Institute, they have a graphic. You know, 43% goes to taxes, 22% on housing, food 12%, clothing 2%, and then they have this other category, which we're going to take a look at the other category in a bit. But it's really quite shocking. And they have a couple highlight points here as well. So they looked at, since 1961, the increases in taxes, and that has increased 2,705% since 1961. And you might think, well, there's inflation and everything's kind of going up, right? Well, the consumer price index, which, you know, basically tracks inflation, is 901%. It went up over that same period. So tax increases has outpaced inflation and the consumer price index by 3-to-1, by 300%, which is quite alarming, actually. When I first learned about this, it's like, whoa, this is, it's not just becoming a problem, it is a pretty serious problem that we have in Canada right now. And, you know, it doesn't look like it's going to get better. So there is a way that we can start protecting ourselves from this once we know what the problem is, right? Once we identify the problem, then we can start working on solutions on how to avoid it for ourselves. We can't fix the whole system, but what we can do is fix what we do within the system to protect ourselves. And they have a PDF, downloadable PDF for this study. It has all the information in it. There's a couple things I just want to show you guys here. You know, the actual increase, the taxes versus the necessities of life. You know, in 1961, we spent more on, yeah, this is the increase of taxes versus the necessities of life. And in 1961, we actually spent more on basic necessities, considerably more, right? Food, clothing, shelter, housing. And over time, that's crossed over, you know, in the 1980s. And now we're basically spending most of our money on taxes, which is crazy to think about. And this graph here really just illustrates that, how much taxes have increased relative to shelter, food, and clothing, which is funny. Clothing has kind of stayed around close to the same, and then our food and shelter has gone up quite a bit to inflation. Well, taxes, they've gone up inflation plus, you know, 300%. So the first thief is taxes. The average Canadian pays 43% of their gross income in taxes. More money than they spend on food, clothing, and housing combined. If you could even keep 10% more of your income each year, how much faster would you reach your goals? What would you do with an extra month's pay every single year for the rest of your life? And that's just the start. And the second thief we need to worry about is interest payments. So in this example, we're going to look at a case study of, you know, a couple in BC, average family, purchasing an average price home, purchasing an average price car with some credit card debt and a line of credit. You know, this is a pretty common scenario. Couple gets together, they have a couple kids, they're making good money, they purchase a house, they purchase the new car, you know, they get a line of credit. They do a little reno on the house, make the kitchen what the wife wants and the bathroom. And then they just keep earning and paying and going down the road. So we're going to take a look at what the actual interest implications of that are. So the average home price in British Columbia is $951,000. So when we take a look at the mortgage, a $951,000 purchase price with a 20% down. And honestly, it doesn't really matter that much if it's 20% down or 5% down, because of these amortization schedules, which is the sneaky thing that the banks do. So a 5% mortgage rate over 25 years, paid monthly. So we have a $4,400 a month payment. Now, if we look at the amortization schedules, what that means is basically you pay more interest in the first, in the first year, you pay $37,000 in interest and $15,000 down on your principal. And it takes about, in this example, 14 years for the crossover point for the $4,400 payment to be half principal and half interest. So this is a really sneaky way that the banks use to start making a huge amount of profit on these loans. And these are loans that the money didn't exist before you took the loan out. This is just fake money. So you can see in the first year, $37,000 is interest, $15,000 is principal. And then it goes down 36, 16, 35, 17. So I created a Excel sheet here to kind of take a look at this. So in the first 5 years of this mortgage, the first year they pay 70% in interest payments. Second year is 68. Third year is 67, right? That's the amortization schedule at work. So over the first 5 years, of this couple's mortgage, they pay 67% of their payments go to interest. So their total payments was $265,000. $87,000 went to pay down their principal loan amount, and $178,000 went to interest. And this is at a 5% mortgage rate. So it's, it's quite the thing. I don't even know how this is legal, but this is what the world we're living in here right now. And, it's the same thing with the car loans, right? So if we look at the average price of a new vehicle in Canada, $67,000, and we take a look at what that looks like, $67,000 purchase price, 5% interest rate for 5 years, and with a $10,000 trade-in value, and then our 7% sales tax on that. The amortization schedules are a little bit better with the car loans, but total over the life of the 5-year loan agreement, you pay $8,000 in interest, and your total payments are $70,000. So I've transferred all these numbers over to the Excel sheet so we can take a look at it easier. So in the first year, they pay 25% interest on all their payments, then 19%, then 13, 7, and 2.7, or 8 and 2.7. So the 5% car loan actually turns into 13% interest payments on average. So they, 13 cents out of every dollar that they pay is going to the finance companies. Then if we look at a credit card, they have a $15,000 credit card at 20%. So they make $15,000 credit card, 20%, and they're making $400 a month payments. So they incurred the debt. Let's just say they did, use that money for the bathroom reno or some furniture in the house, and they start paying it down every month. A $400 a month payment over 60 months. So their total payments is $23,000, and $8,000 of that is interest. So the first year, first payment 63%, 62, 61. This is another amortization schedule. So in total, on their $15,000 credit card at 20%, they end up paying 36% interest. So they're making their payments at 20% loan amount, but with the amortization schedule and compounding, they end up paying 36 cents out of every dollar gets vaporized to the credit card company. And if we take a look at a line of credit, it's very similar. So a 9% line of credit, $28,000 500 loan, and they're making a $600 payment every month, right? And knocking that down over 5 years. They're diligent. They don't take any more credit out. This was just for the big home purchase price and, to kind of get things set up and going. And, they know they're making good money, so they're just going to keep knocking this down and playing honest banker. They end up paying 19% total average on a 9% loan, right? So their total payments was $35,000. They pay down their loan and they end up paying $6,867 in interest payments, right? So this is the trap. This is why, a lot of rich people, they go, I don't take on debt. I pay cash for everything, to avoid this. But there may be another way that's even better, where we can flip this script on its head and start earning that compounding ourselves by replacing the financing needs ourselves. So if we take a look at these numbers, Over 5 years, with the mortgage, the car loan, the credit card, and the line of credit, they made total payments of $395,000, and they made $202,000 of interest payments. So even though their mortgage was at 5%, their car loan was at 5%, the credit card's at 20%, and their line of credit is at 9%, they ended up by volume paying 51% of their dollars. So 51 cents out of every dollar got vaporized to interest payments. And if we look at that by average, so if we average the 67, the 13, the 19 and 36 and divide by 4, that gives us an average interest rate of 34%. But there's a key point that in the infinite banking circles we talk about, and it's not about the rate of interest. It's about the volume, right? And the average interest rate or the loan interest rate doesn't tell even close to the full story. The real story is the volume of interest. This is actual money that you paid out, not theoretical with amortization schedules like fairy tale numbers that we've been conditioned to, well, my mortgage is at 5%, it's okay. This is the real deal number here, is 51 cents out of every dollar gets vaporized for this family here. The second thief is interest. Interest takes another 20% of your gross income. Mortgages, cars, loans, lines of credit, credit cards. Think about this. An $1,180 a month car loan is over $14,000 a year going straight into somebody else's bank. What if every interest payment you made went back into your own account instead of theirs? What if you could buy the things you need and still have your money working for you the whole time? Now, what's the solution? You're probably wondering, like, okay, well, that sucks, but what do we do about it now? So we're going to take a look at a life insurance contract. And like I said before, this family makes about $250,000 a year household income to be able to qualify for these mortgages and car loans and everything. And they're saving about 10%, so $25,000 a year. So we're going to look at a insurance contract now that's 35-year-old male, non-smoker, and this is just for illustration purposes. Like a family making $250,000 a year, they could qualify for significantly more insurance than this. But we're going to just take a look at using that savings chunk that they're saving and trying to replace the financing needs and how that would look. You can always expand your system, but I tell this to a lot of people, like, let's just start small. Let's get you trained in the habits of using the insurance as a banking system, and then we can expand it later. There's sometimes people want to go too big too soon or too little too late. We got to find that Goldilocks zone. So this is a good starting point for this contract. So they put $25,000 a year instead of into their savings account into a life insurance contract. And after year one, so it takes a few years, right? In this example, it takes 4 years for the premiums to equal your cash value. And that's because there's cost in setting up these contracts, the insurance companies, the actuaries, the life insurance agents. So there's a bit of a cost to set these up, but then after you hit this crossover point, it's exponential compounding growth, right? So in the first year, $22,000. So we're going to take a look we're going to replace all the financing needs with this. So here's the numbers straight off of the policy. So in the first year, they put in $25,000. There's a $22,000 cash value. He takes a $15,000 policy loan at 6.5%, and that replaces his credit card financing. Boom, year one. And instead of paying the $400 a month to the credit card company, he starts a loan repayment schedule to himself. So the $4,800 a year that was going out to somebody else's system is going back into his system. So now he only has an $11,000 policy loan, and he's got $11,000 cash value. Second year, he makes the $25,000 savings deposit into his insurance contract, and then he takes out, the loan amount compounds at 6.5%. Then he takes another loan for the $28,000 line of credit. So in 2 years, he's replaced the credit card financing and the line of credit financing. And now he's also making that $600 a month payment that he was making to the bank for the line of credit. He's now paying that back into his own system. So now he's making a $12,000 a year loan repayment back into his policy. So this is the same, again, we're talking about the exact same cash outlay. They were already making a $400 payment to the credit card company and a $600 payment to the bank. Now he's paying it to his own banking system, where that money grows and is protected from tax, and it compounds uninterrupted. So he continues on making his yearly premiums, and he's diligent, or they're diligent, paying down their loans. So at year 5, there's a $129,000 cash value. Now he's ready for a new car. So he takes out a $62,000 500 policy loan for his car. And now that $14,000 167 that he was paying to the car financing company or the bank, the $1,180 a month he was paying, now he starts paying that back into his own system, paying down the policy loans for that. So now he's channeling $26,000 that was going out, and he's cycling it back into the family banking system, back into the infinite banking system, into his life insurance contract. So after 5 years, the credit card financing, the line of credit financing, and the car financing is totally replaced, which is well over 20% on the dollar that was going out before, and vaporized money is getting recaptured and recompounded. So let's continue. They keep making their savings, and they keep making the same loan repayments that they were doing. Well, here at year 7, the car is paid off, and they're flush with their cash value. There's no more room to put money in. So they're diligent. They, just keep making their $25,000 a year savings deposits, and they don't take out any additional policy loans, because at year 10, they're going to finance a new car. And if we take a look at the amortization schedule for the loan, for the mortgage at year 10, so he has $561,656 owing still on the loan, and he's only paid down $199,000 in principal over 10 years, with $331,000 going to interest. So what we're going to do is we're going to take out an additional $214,000 policy loan, and we're going to knock down that mortgage. So now, with that additional mortgage payment, now he has a $2,700 a month mortgage payment instead of a $4,400 a month mortgage payment. And what we're going to do now, because they understand how this works, you don't want to steal from your system. You were already making a $4,400 a month mortgage payment. So now he's still making a $2,700 mortgage payment, or they're making a $2,700 mortgage payment to the bank. Well, that difference between the $2,700 and the $4,400, we're going to put that back into their system, right? So you see how the number jumps up here to $46,000. So they're making their $26,167 from their car, credit card, and car financing. And now we're going to add in the $20,000 a year that was going to the bank before, back into their own system. And here we have half of their house financing totally replaced. So they continue on. They keep making their payments every year, paying down their policy loans, putting the money back into their system, and they keep making their $25,000 a year savings deposits. And at year 15, we take out another car financing loan, and now we take out $258,000, $566, which is what we needed. So in year 5, that's the mortgage balance. And year 5, $258,000, $566. And now we have the house financing totally replaced after 15 years. So now, instead of making that $2,700 a month payment to the bank with the reduced mortgage amount, now we're going to recapture that as well. So we're going to make the full $4,400 a month payment back into our own system. So now they're making $79,000 a year payments. That's how much they were paying to the finance companies, to the banks, to the credit card companies, was $79,000 a year. Now every penny of that is going back into their system, and it's getting compounded, tax-free for the rest of their life. How good is that? So they continue on, right? They keep making their savings deposits. They keep making their loan repayments because they're honest bankers. Now at year 20, something spectacular happens. They finance another car, but now there's $650,000 available that, for their daughter or their first child, they can finance a house for them. Maybe their daughter was 3 or 4 years old at the time, and 20 years later, and they're ready to start a family and purchase a house and start their own life. Well, they don't need to qualify from the bank now. They don't need to do anything except for, talk with the family and say, hey, I'd like a loan for $650,000, and instead of paying the bank, I'd like to pay the family. So, honest bankers, we calculate a $650,000 home purchase price, and we find out the payments are $3,600 a month, $3,689 a month. And so what else happens here is after 20 years, the house is totally paid off. So they don't need to make any more house payments. So instead of instead of the $40,000 a year or $4,400 a month mortgage payments, the parents don't need to make those anymore, but there's enough money to finance another house for one of the children. So that's why this number goes down here. So if we do the $3,600 a month times 12, so that's $44,000 a year. Now the family's totally cut the bank out for a second house. And the daughter or the first sibling, first child, starts making mortgage payments to the bank of mom and dad, to the family bank, right? And after 25 years, there's still a loan amount because they're knocking it down slowly, right? There's still a $560,000, or we do another car financing, there's $500,000 in cash value left in this policy. We've totally replaced the car, the credit card, and the bank financing, which, if we remember, in the first 5 years in this example, 51 cents out of every after-tax dollar, this is after-tax money, was getting vaporized. How good is that? And if we look at the other guys, you know, using the standard 25-year amortization schedule for that loan, they paid down $761,000 loan, but they ended up paying $566,000 in interest payments. So they made a total payments of $1.3 million, but $566,000 of that was interest. And the total car payments over the 25-year period, $354,000, with $41,000 going to interest. And the total credit card payments, $43,000 going to interest. And the credit line of credit payments, $34,000 going to interest. So if we look at the total of the other guys, it's $1.9 million in total payments over 25 years. The total interest is $686,000, and the total principal is $1.2 million. So it's almost exactly double, or 50% is, you know, their total principal was $1.2 million, and they paid $668,000. You know, it's 50 cents on the dollar of these payments that are getting vaporized, that this family gets to recapture. So the core problem is this wealth transfer. Taxes plus interest, and 60% of your gross income is gone before you even think about saving. The government gets paid first, the banks get paid second, and you're last in line. If you could reverse the flow of money so you got paid first, how would that change your financial future? What would it feel like to finally be in control of your own money? So here's the trap. When you're the borrower, compounding works against you. You lose control, you lose opportunity, you feed someone else's wealth engine. Albert Einstein once said, compound interest is the eighth wonder of the world. Those who understand it earn it, and those who don't pay it. What would it mean for your family if you could turn the compounding power of money in your favor for life? If you could have both liquidity and growth at the same time, how much more confident would you feel about your finances? Now for the solution. The solution's simple. Stop being the borrower. Become the banker. Pay yourself first. You grow your capital uninterrupted. And you borrow against it, not from it. And you repay yourself instead of RBC or BMO or any of the banks that you use. So if you could buy your next car or investment or property or piece of business equipment and still have that money compounding for you, how much more could you accomplish? If you could create a financial system where you always got your money back, wouldn't you want to know how to set that up? So here's how it works when we apply this to everything and not just cars. We use a properly structured life insurance contract to replace financing for cars, credit cards, lines of credit, and even your mortgage. In this case study, we were able to pay off a house entirely, finance a $650,000 home for their daughter or first child, and still have $500,000 in cash value after 25 years. Totally replace car and any outside financing for the family, and also deliver an additional death benefit on top of the $500,000 cash value if anything did happen to the life insured. Now compare that to the traditional route, where 34 to 51% of your dollars get vaporized in interest payments. You pay $1.3 million for a house over 25 years, and of that, $566,000 is pure interest going straight to the bank. And at the end, you have a house, but that's it. Would you be worse off to have your home paid off, your kids in a home, and still have over $500,000 left, rather than paying $566,000 to the bank in interest? And remember, this is the exact same cash outlay. This is just a different flow of money that benefits you. Would you feel less secure knowing your family's future is funded without being at the mercy of the banks? And ask yourself, if this worked for another family, is there any reason why it wouldn't work for yours? Would you tell somebody to wait 5 years before starting? Or would you tell them to start now, knowing what you know? And if we just take a look at this for a second, the interest payments. So this is what most people are doing. They're paying the 34% average. As we know, it might be actually worse. But they're paying 34% average interest payments. And then we look at the guy who pays cash, right? He's at 0. And then we look at using the infinite banking concept and getting 5.5% interest on your money. Just as a rate, which is not the most important thing, right? It's about the volume, but just as a rate, this family's doing 39.5% better than everybody else, right? It's like creating a tailwind for your financial ecosystem, right? Where everybody else is losing 34 to 50% of their money on taxes, inflation. The guy who pays cash, he's avoiding that loss, but he's losing control of the money. With using the infinite banking concept, you get control of that money and plus an additional growth. So it's not even the same game you're playing as everybody else when you're using the infinite banking concept, right? Like, you think Warren Buffett, legendary investor, he gets 20% annualized return on his money, right? That's pretty much as good as you can get over a long period of time. Well, wouldn't it make sense to not lose 34.5% or 34% and then just focus on gaining a 5.5% tax-free compounding return? Isn't that better than just chasing a 20% return with 10% of your money? Is trying to control and compound and build a tailwind for as much money as you can. It's, like I said, it's not even the same game. So the benefits you'll gain: you recapture all interest payments, which in this example was 34% average to 51% of any financing charges going to interest. You reduce your dependency on banks. His daughter was able to, or first child was able to finance a mortgage without any qualification. There's tax advantage growth. Any growth on the money in these policies is shielded from tax, which means your 5.5% return is more like a 9 or a 10% return in another investment. And there's uninterrupted compounding. When your dividend's declared for the year, that's your new floor. These contracts are just that, they're contracts. They're contractually guaranteed not to go down in value. They're not market linked like a traditional investment. You got access to capital at any time without penalties. There's no qualifying, or your money's not locked in like an RRSP where you have to pay 30 to 50% tax to get it out. And there's a multi-generational wealth transfer. The death benefit flows tax-free to your beneficiaries, and also any policies you own on your children, you can transfer ownership of those tax-free. You have the flexibility to finance anything, cars, homes, business equipment, from your own system. You're not beholden to the banks or anybody else. And the pitfalls you avoid paying interest loss to the banks, which, a 5% mortgage all of a sudden is 70% in the first 5 years and 40% over the life of the contract, and your taxes eroding your wealth, which is 43% of gross income for people. So even if we can save the income tax on the growth on any money in the policy is huge. And there's no market volatility losses. You're not at risk of the money dropping by 20% and screwing up your plans. And the locked in investments you can't access. This money is fully liquid. And you also avoid the endless debt cycles. If you could have all these benefits while avoiding all these pitfalls, would you say it makes sense to take control now? If you wait, will the banks and the government start taking less from you or more? And knowing every year you wait means more of your money is gone forever, is there any good reason not to start today? If you want to see exactly how this works with your own numbers, let's talk. I'll run your exact scenario so you see in black and white what becoming your own banker would mean for you. We'll start with a conversation about where you're at and what your goals are. Then we'll work with you to create a plan that works for you. Then we'll run your numbers and show you how you can start taking back control of your money. If you could see that kind of clarity, would it be worth it to you? I know we covered a lot here, and some of this information may come as a shock to you. I know it did to me. And even once I learned it, I still had fear holding me back from taking action right away. I talked to people who didn't understand infinite banking in Canada, and I got some bad advice that ended up costing me a lot of money and a lot of lost control over my money. I just want you to know the anger you feel at the truth of how the system is designed to take our money is normal. And the fear of stepping into a new way of doing banking, that's normal too. I'm just glad I had somebody from the Infinite Banking Canada group walk me through the process, step by step. And that's why I joined the Infinite Banking Canada group. Because when you're ready to take that journey, I hope I can be that person for you.